business owners, do you want a smarter way to think about your business's income? Hello, my name is Nick. I'm a fractional CFO with Living Water Consulting here in St. Louis in the Metro East. And today we're going to talk about how gross margin becomes your best decision-making tool. So to start off with, I want to say is you don't have a problem with revenue. You have a margin blind spot. Most owners over-obsess about the top line revenue, meaning that's the vanity number. That's the number you tell your friends and other business owners that you made, right? But the problem is that not using that number can really distort your decision making. So what's most important is not the revenue that you made, but the revenue that you keep. It's the magic in it. It's what you keep, right? And that all starts with gross margin. That's where the strategy begins. So let's think of revenue as a river, right? Gross margin is actually what you can take with you and put in the bank. So what is gross margin? Simply put, gross margin is your revenue minus your direct costs. Let's take that a step further. Your gross margin percentage is that gross margin divided by revenue. So let's take a quick example. Let's say you made $1 million in revenue this year, but cost of goods sold was $600,000. So really, you have a gross margin of $400,000. Now, this is a great time to just stop right here and say, just forcing yourself to look at these three numbers. If you were in a room with different entrepreneurs in different industries and you were able to look at this figure, you could have a very robust and interesting conversation that would actually make sense. It would be a more comparable apples to apples rather than apples to orange situation. Going finally here at the last, gross margin percentage is at 40%, we can see from this example. So what do we do instead? We need to start using margin as our decision filter. So let's use margin to ask smarter questions like, can I afford to hire with this margin in mind? Taking the example and tweaking it just a little, let's say we had $100,000 in revenue and $40,000 in gross margin. Well, if we're going to hire someone, that's a lot different of a decision having $100,000 for someone versus $40,000. And also, what's most important is, does this price still work at 50% gross? Because what we're going to say is that your price, after you take out cost of goods sold and everything else, is, are we going to have anything left over, right? So you want to make sure that your price still works, even at a lower gross. And let's go ahead and, instead of discounting it, we're going to increase it. I mean, hey, y'all are some premium products and you're providing value. Why not increase it? So another question to ask is this client, is this offer, or is this SKU even worth it? Meaning, is this sale worth it with this gross margin? If you looked at an example, if I'm going to spend $1 million in, or if I'm going to get $1 million in revenue, and yet I'm only going to, and I'm going to have a cost of goods sold of $900,000, I'm only making $100,000 off of it. That's not very good, right? Finally is, can I scale without margin collapsing? Now, I'm going to tell you, oftentimes margin is going to start decreasing as we get larger and larger, maybe not. But you don't want it to completely collapse. You want it to be still within the range of what you're doing, hold true. And one of the things I say is you need to have that unit good, whatever that unit is, before you scale that unit, right? So let's talk about what we do with gross margin. We're going to put it into different buckets. Matter of fact, I was just having a conversation about this today, and the first thing you should do is put about 25% into taxes. Why? Because you're going to have to pay Uncle Sam. And let me say this. Your best key performance indicator of creating wealth is the tax liability you pay to the government. And I'll say that again. Your best key performance indicator for creating wealth is the tax liability you paid to the government. Think about that. Y'all, just to go back real quick, what would be interesting is if we all would sit there and say, I paid $400,000 to Uncle Sam. I paid $500,000 to Uncle Sam. I paid $1 million to Uncle Sam. Nobody really wants to have that conversation, but it's kind of bragging that would be something to really brag about, rather than I made $1 million versus I only kept $400,000 of it, right? Let's go on to the next thing though. So I changed this a little bit different than if you've read Profit First book, because I want to say this is taxes are most important, because there's a big problem with paying that and having that liability. And I don't want you to go to the end of the year and then try to reduce your profits in order to reduce your taxable liability. The next thing is making sure that your marketing is that you have money to allocate towards marketing. Again, whether you're successful or whether you're in dire times, your marketing budget needs to hold firm, because let me say this, if that's going to go down, that decreases the number of impressions, the number of reach, the number of conversions that you have, right? So we want to keep that number good and solid. Going forward, we're going to do our operations at 35%. And this is where we're going to start talking about owner's pay. We're going to pay ourselves up front a regular market-based wage. We're going to do that about 15% or so. And this number can change depending on how successful and how big your business actually is financially. And then finally, 10% profit. That's almost the new break even. We'd like to shoot for at least higher, not necessarily lower, but just breaking even at zero isn't going to cut it. We're here to make money, to make a profit. So margin is a GPS for your business. And let me explain a little bit. First of all, should I discount this product? The answer, if you're with margin in mind, no, you're taking margin, you're taking profits away from yourself. We want to keep those as inflated as possible, right? Should I hire another person? Well, again, as we talked about before, does the margin, not the revenue, support it? Can I grow my ad spend confidently? Well, yes, again, if the margin allows it. So that working with that margin buffer and knowing your percent and amount of margin is key here to knowing how much can you grow your ad spend. So why is it that some people still feel broke at $1 million in revenue? Well, probably because they've been thinking from revenue and not thinking from gross margin. So why is this important to you? Always start with margin, not with revenue. Have a gross margin target. Again, kind of looking at what you did before and then let's say, can we improve it from here? Once we start tracking it, the Hawthorne effect says just by tracking it, we can actually improve our performance, right? So let's use it to drive our pricing, our hires, our offers, and our pay rather than revenue, because it's a distortion. So gross margin is not accounting. And frankly, who cares about accounting? Get a bookkeeper, get an accountant, have them do that. That's boring stuff. It doesn't add a lot of value to how your business is going to profit. It keeps you in the weeds of actually losing profit in order to minimize your tax liability. So what's your next move? Go to livingwaterconsulting.com/checkups, where you can grab our free, easy P&L calculator and find out where you stand today. Also, there's an easy P&L calculator with data put in it, so you can see just how this would work. It's real simple, makes it a breeze, and if you use AI, it's probably going to be even simpler. So it forces you to put it into a model so that you'll know exactly what your gross margin is.